Welcome to Module 5. This is about planning entries in advance and calculating your risk properly. In this module, what I'm going to cover is showing you how to plan your risk based on a currency or on a drawdown amount rather than using stops. In the last module, we spoke about how not to use a stop loss is going to make us more profitable as traders, because we're going to let our trades, our probabilities, our statistical edge play out in the market without the market makers using their stop hunts to take us out and make us cross. Okay, now you'll very rarely get the perfect entry, all right? So as retailers, we tend to historically focus on our entries. We're looking at our indicators, our charts and our system, and we're waiting for price to get to a certain point where we want to get into the market, all right? And the reason we do this is because it makes you feel good when you do it, right? So if we get a breaker and we see that breaker happening, it's at a good level, we get in and immediately that thing shoots off and hits our TP within 20 candles, we're thinking, wow, I nailed that. I'm an amazing trader. I'm going to take a screenshot of that, I'm going to stick it up on Telegram and show everybody how amazing my entry was. And you'll see this on Telegram groups and Discord groups. It's full of people showing off amazing trades, huge risk rewards, their profit figures. You know, there's loads of people out there going, haha, look at me, I'm amazing. But it's funny how they never show you all the blown accounts they've ever had, the negative P&L from the other 95% of the trades they've taken, which didn't nail that perfect entry. Okay, and it's very hard. We want to get the perfect entry, but it's rare that we'll ever find it. And we know this because we get hunted all the time. We get stop hunted all the time. So we know we're no good at this. So why are we still trying to do it? It doesn't make any sense at all. It's rare to get the perfect entry, so we just got to stop trying to do it. So it doesn't matter if you get it spot on or not. What matters is your directional bias is correct. And just getting in at some point in that move in the market is all we need to do to make money, all right? So when you stop trying to pick these tops and bottoms and accept that being temporarily wrong is okay, you just immediately start to make money by default, all right? And our goal is to make money and be consistent, not to get the right entry and brag about laser targeted entries with a 5-to-1 risk reward ratio on Telegram. That's not our job. Our job as traders is to manage risk correctly and to make money, all right? So we need to know how to calculate our risk and our lot sizes, more importantly, to make sure that we keep our trade entries and our portfolio comfortable. The main problem I find with traders is they over leverage. They get into the market with a lot size that's too big, and as soon as it sort of turns around and slightly comes against you, you're panicking, your palms are sweating, and you're like, oh my God, this thing's going down, I'm going to lose £100, and it's negative. The whole thing is negative because you're oversized, you're worried, and you're worried because you're taught to risk a percentage on your account every time you get in, and it's totally wrong. Okay, so we're going to use a stop, but we're going to make it a monetary value. Okay, it's not a level. Okay, and our lot size is going to be related to the plan that we put into place. This is how institutions trade. They scale in to positions and they scale out of positions. All right, they're riding a wave, they're riding a move, and they're getting in and out as it goes up and down. Okay, so we're going to mimic this. The stop, if you like, in our case, becomes an alarm bell to tell you to think about getting out or plan what your next move is going to be. All right, so let's say, for example, I've got a hypothetical stop loss of £500, right? My monetary value I've set when the euro pound gets to £500 in drawdown. That's when I'm going to start looking at this and go, not worked out. I'm going to now have a look at what I can do about this situation. And what I can do about this situation is look at my profit, I can start scaling out of the position, I can look at where it is now, whether or not there's further positions I can get into. There's all sorts of things we can do which we'll cover, and I'll cover much more in the live room, in live trading examples, because there's so many things that can happen. It's very difficult to put them all down on paper. But I'm going to show you how to do some damage, some drawdown control in the next module. But for now, we need to concentrate on how we're going to get into the market and what lot sizing we need to use. All right. So step one, we need to split our trade into X number of parts. All right. So when we get into this trade, we're going to assume that we're going to be wrong. We're going to plan to be wrong on this entry. Ideally, I like to plan for no more than 3 to 5 initial entries when I get into a position. And I'll show you how I'm going to do this, but that's your plan. Your plan is to get in and have a backup plan with a few more entries depending on what you can see on the chart. And this will often be determined by the levels you can see that are likely to be stop hunted if you're incorrect with your entry. All right, so let's have a look at an example. This is a euro-pound position. All right, we're going back to July 2020 here, so it's just something that's happened in the past. But I wanted to use this as an example to show you hypothetically how you would work this. All right, so you can see here. Let me just get my pointer. This is our entry. All right. So hypothetically, we've decided we're going to get into this trade. I'm going to go long. Okay, I'm going to go long from here because I've seen this lovely, it's a bullish engulfing candle, which it actually isn't. All right, it's a bullish candle. It's not an engulfing one. Okay, my RSI is below 32 down here. Okay, and it looks like it swept yesterday's lows. All right, yesterday's lows are here. All right, so that's my reason for getting into this trade. We've swept yesterday's lows, the RSI is low, and we've seen a nice bullish candle. Okay, so we think this is probably a stop hunt, and we're just going to shoot off and go long from here. All right, so my first entry is going to be here. Now, if I'm wrong, okay, if I'm wrong, price could come down and sweep one of these lows here. All right, so there's a low here. There's a low here, and there's a low down here. All right. So realistically, if I don't get this entry right, the chances are what's going to happen is price is going to trade down to this level and bounce. All right. That's what I'm thinking in my head. If I'm wrong about that one, price is probably going to come down and bounce off of that level. Okay. So that's my second fallback, if you like. My third fallback would be, if both of those are wrong, it's going to come down and it's going to bounce off of that level. All right, it's going to do some stop hunts somewhere. I just don't know where. I think it's this one here. I think we're ready to go. But if not, that's my plan. Okay, so when I get into my trade, I've got 3 backups there. So I've got 4 entries planned on this trade. Okay, I can see an obvious target. We've got a propulsion candle here. Nice little imbalance in the market, and it looks like price is going to trade up to here. So my plan is just to take a trade from here to here, and ideally, if you remember back to the previous module, what I want to happen is get in here, price goes up there, I get out, thank you very much, done. That's what I want to happen. That's my ideal trade scenario. But if that doesn't happen, my backup plans are here, here, and here. All right. So how can we calculate our lot size? So we've got our plan, and we need to have a worst case scenario. So the worst case scenario in this particular instance wouldn't be that 4th entry, but I need to know what happens when I get down to that 4th entry. How deep in drawdown am I going to be when I get there? So I need to make sure that my initial entry into the market, my initial lot size that I'm going to use for this trade, will be within my risk tolerance, my maximum that I want to be in this trade for. All right. Remember, the RSI is really low and it's due to rise up. Okay, we know that because we know when the RSI gets below 32, it's thinking about going upwards. This is what it does. It's a cycle. It's an oscillator. It goes up and down. So we've got lots of things in our favour to give us confidence in getting into this trade. It could push down though. It does. We've seen this with the RSI, and if you did the homework, you would have been watching that RSI in the trade simulator, and you'll have been seeing it go up and down. You've been seeing what it does. Okay. So it could push down again, but realistically, probably not much further. But we've identified where it's likely to go if we're wrong. And why have we done that? Because the market needs to stop hunt. And that's where they will likely go and perform these stop hunts. All right? So we've got a plan because we know what is going to happen. We know what the market typically does. So we can easily plan in the future for what is going to happen. Okay? So the next step is we need to calculate a small lot size and fire off our first sort of tester trade to see if we're right. Okay, but what size? We don't know what size to get into. So let's see how we can work this out. So we've got our trade here. We've got position 1, position 2, position 3 and position 4. Now I've decided to get into this trade with a lot size of 0.30. Okay, so 0.3 of a lot. That's what I'm going to get into. Okay, if price trades down to this level, my position will be in £150 of drawdown. Okay, so when it's moved from here to here, that initial entry will be £150 in drawdown. Okay, now if it gets down to here, I'm going to take my second entry, position 2. If price continues to move further down, and I'm wrong on position 2 as well, position 1 will be in £233 a drawdown instead of the 150 it was at. Position 2 that I took here will be in £83 a drawdown. So my total drawdown now on these two positions is £316. Okay, so I'm still comfortable with that. All right, 500. I start to think maybe I should be looking at being wrong on this one and a way to get out. All right, so I'm still comfortable if position 1, position 2 and position 3 fail. Now if price comes down to position 4, I will have got in at position 3 obviously. Position 1 will now be in £305 a drawdown. Position 2 will be in £155 a drawdown. And my last position I just took, position 3, will be 172. So now my total drawdown is at 532. Okay, so I've got a decision to make when I get down to this level. Shall I take another trade or not? I've planned to take a fourth position here, so I might as well take it. But at least I'm aware of how much drawdown I'm going to be into as a worst case scenario getting down to position 4. Alright, so this is how you work it out. You've got to work out what your maximum drawdown is going to be. Right. This is quite a difficult thing to do, and you'll get an understanding of this over time. But what I'm going to show you in a second is a simple way to calculate this manually when you get into a trade. And you will get used to each pair, how far they tend to move, and you'll get a feel for roughly what sort of lot sizing to use based on how far you think price is going to go against you if it does. Okay, but that's how we work it out. So we need to know the total of all of our positions when it gets down to a certain level. And obviously if we took position 4 here and then price continued to move against us, these numbers would be getting bigger and bigger and bigger. And at that point I would want to start doing some drawdown control, which we're going to cover in the next module. So we know now we've got a way to calculate our lot sizing. So we've got two potential outcomes now. One, we're going to be right, we're going to make money. Two, we're going to be wrong, and we're going to get another shot at making money. Right? We're going to get another shot at making it right. Now, actually, we're going to get 3 shots or 4 shots. It doesn't matter. We will work out how many shots we think we're going to get based on the chart and the trade that we're looking at. We now know what our drawdown will be if we are wrong down to position 4. If 500 is our limit before we start feeling uncomfortable, we know that we can really only take 3 positions, and when we get to position 4 we're going to have to start getting out. Okay, but at least now we know that, and we've got a plan in place for that to actually happen. You can be temporarily wrong many times before you are right. The key is not to take a loss while you're temporarily wrong. The key here is the uncomfortable bit, okay? We know we can be wrong on this trade 3 times and feel comfortable in it because we've said we're happy for £500 to be our limit before we start thinking about getting out. So we know for a fact we can sit there and watch that trade going down and be comfortable with it because £500 is absolutely fine. If we've got a £30,000 account or £50,000 or 20,000 even, 500 in drawdown, you're not going to feel too uncomfortable about that, all right? So this gives us more confidence to hit that buy button. If we've planned the trade out and we know what's going to happen at each level, we're going to be happier to hit that buy or sell button now. We're going to be more confident to take our trade. You are feeling comfortable when you take a trade because you're not worried about that trade going 20 pips against you and losing your money. Each pair needs a different lot size based on your plan. Actually calculating the right lot size is tricky. Now I'm developing a tool at the moment to help with this for MT4. So hopefully by the time you watch this, it'll be available. But for now, here is some advice, okay? Start off with 0.01 lot sizing for every £2,000 in your account, or $2,000 or 2,000, whatever your currency is, euros, doesn't matter. Whatever 2,000 you've got in your account, start with 0.01 lot sizing, all right? Ideally, I want you to start with a 10,000 account, so we can use a 0.05 lot size as a starting point. It'll become clear in the next module why I want you to have a 0.05 starting point. You can have a lower one, but I want you to get comfortable trading in this way, and the easiest way to do that is just to use a set lot size for every single trade you get into. Okay, so this will make sure that you get in at the same lot size for simplicity's sake on all of your pairs, and we'll be setting our targets and trading at levels, and this will make you feel totally comfortable with not having to think about lot sizing or worry about it at the moment. What we need to do first of all is get used to trading without a stop, get confidence in trading without a stop, and see what happens in drawdown and see what happens when price comes back and goes into profit. Okay, so I just want you to get comfortable breathing with the market and taking profits basically after your drawdown cycle is completed. Okay, you're not going to make a fortune, but you won't be worried at all either when you're in drawdown, and that's the key. I want to turn you into a trader that has an 80% plus strike rate and a daily profit P&L being shown. Right? I want to see profit in your account on a daily basis. I want to see an 80% strike rate. Forget the money. Forget about the money for the minute. It doesn't matter whether you are in a demo account with 100,000, you're making 10,000, or you've got £1,000 account and you're making 15, 20 pounds. It's relevant. Forget about the money. Get used to trading in this way, trading this cycle. Okay, we can always up our lot size at any point when we get confident enough to do it, and when we understand what lot sizing we need for each of the pairs that we trade. But if we go in too big to start with, you can't go back down. Okay, if you've got a £10,000 account and you start going with 0.5 lot size, this is your first entry, you're going to be uncomfortable. By the time you get to that second entry, you're going to want to get out. Okay, so scale it right back. I just want you to get into the market and out of the market with small lot sizing. If you take a trade at 0.05 and it's way smaller than you are comfortable with, and you want to get more out of that trade. Okay, so what I mean is if you get in with 0.05 and you calculate your TP and you figure out what the drawdown will be, and you think, well, actually, that's only going to make me £20, and that target, I want to be making £50 or whatever on it. You can always get in more than once. So take 2 0.05 trades, all right? You can always add another trade to it. Or if you get to level 2, let's say, and you realise, actually, I'm only in £25 drawdown, I expected to be in £50 drawdown by now. Get in with 2. Get in with 2 0.05s at that level, at the second position. Okay, we can play with this, but start with a set lot size just to make it simple. I want you to simplify the whole thing so you've only got to worry about getting in and out of the market at specific levels to get used to this, okay? So what we're going to do is I'm going to quickly show you an easy way to put your potential trades on as pending orders, and I do this a lot. All right, so when I've done my trade plan, when I've seen a potential entry I want to take and I've seen where I'm probably going to take my next entries, it makes logical sense for me to place pending orders in the market at those points so that if price hits it, I don't miss my second entry. Okay, if I'm trading yen pairs, for example, or Aussie pairs or New Zealand pairs, in the UK here, there's a lot of movement in the Asian session on them, and I'm asleep. So I can't necessarily get into those pairs when I want to, because they might make their moves overnight and I might miss them. So I might miss a good entry. Okay, and this is how I get some of my most laser targeted entries as well. Okay, some of the best trades I have, I think I've shown trades actually where I've basically got a sell and it's pretty much at the very top of the peak formation high candle, and I've entered almost to the pit when it turned around. That was a pending entry, but it would have been a position 2 or position 3 entry because I know price is going to come up there and sweep that area. All right, so let's have a quick look at how we can do this. So I've got the pair up that I just showed you that graphic of, so let me just quickly whiz back and show you that. All right, so this is the euro pound. You can see that bullish candle there, and we're going back to this would be our position 4 entry. All right, so sorry, okay, so there's our bullish candle, which wasn't a bullish engulfing, it's just a bullish candle. And there's our position 4 entry. So let me just quickly mark these on the charts. So there's our position 4 entry, our position 3 entry, our position 2 entry, and we're getting in there. All right, price is actually quite close to this area at the moment, I've just noticed, so hopefully you won't get triggered. So I'm going to take my first entry here. Okay, so let me set, we'll use the example in the trade of a 0.3. Okay, so my first entry would have been here. Okay, at, let me just move that. There we go. At a 0.3. All right, so I've entered it with a 0.3 there. Okay, I'm going to set my stop loss. Let's just pull a stop down and set a TP up. So my TP, oh, sorry, I've moved the entire order there. Let me just move that out of the way. Okay, so there's my entry. Okay, so you remember the on that slide I showed, our second entry would be there, and at that point I would be roughly £150 in drawdown on that entry. If it moves down further, I will be roughly at £225 drawdown. When it gets down to here, I'll be roughly about 300 odd. All right. TP is going to be up here, so I'm going to make 340 odd on that trade when it comes up to that imbalance that I identified in the market. Okay, so let's take our second entry. So while I'm here, I've planned this trade out. I might as well get another buy limit in. Okay, we'll get a stop loss put in there, a take profit put in there. Okay, pull our TP up, so when this one hits our target, we'll have made about 480 odd. And if this one gets down to our third entry point, I'll be about £76 in drawdown, and when it gets down to the fourth, I will be about £150 odd in drawdown. Okay, so I've set my second pending order. Same with our third one. I'm going to set our buy limit. We'll put TP on it. And a stop loss. I'm going to remove these stops in a minute. I'm putting them in just so that I could show you. So I'm doing this the wrong way, aren't I? So we'll split that 0.91 and 0.95. Okay. So the TP on that order will be 560, and the stop loss, if it gets down to position 4, will be about 75 odd pounds. All right. So I've got my third entry in there, my second entry in there, and let's just move these out of the way. And then we can put our fourth entry give it a stop and give it a TP. Okay, so if this position, I have to get into this position, when it comes up and hits our target, I'll make 635 odd on that one. All right. So let's get rid of these TPs. Oops. Actually, I can't get rid of the TP. Yeah, I can cancel stop loss. Oops. There we go. So all the TPs are gone. All right. So there's my trade plan. Okay. I've got my initial entry, which I just moved. There we go. So I've got my initial entry. I've got my position 2, position 3, and position 4 all set up in the market. I've got my take profits in place for each of them at this imbalance area that we've identified as being our target. All right. So basically now I can just shut this chart and walk away and just let this trade play out. And if it goes into drawdown and I'm wrong on my initial entry, this will get triggered. If that one's wrong, this will get triggered. If that's wrong, this will get triggered. Okay, and I will be monitoring this trade. Obviously, it's on an H1 chart, so I'll be checking the trade out on a regular basis. But I've planned the trade, I've put my pending orders into place, and I'm now in this. So I'm now long euro, and I'm short pound. My bias now is long euro and short pound. If I see another amazing signal come up now on a euro pair, euro yen for example, to go long, I'll be like, okay, I can do that because I'm long on the euro, because I'm long euro pound. Okay. If I see an amazing sell opportunity on the euro yen, I'm not going to take it, because otherwise I'll be long the euro here and short the euro on the euro yen trade. And the same with the pound. If I see another pound opportunity, I need to make sure that that pound opportunity is a sell, because I'm short the pound, because I've gone long on the euro pound, I'm short the pound, long the euro. All right. Okay, so let's have a quick look at how this panned out. I haven't actually checked this, so we could go horribly wrong here. So let's just step forward. We've hit our second position, so we're now in 2 positions. We've sprung up nicely. Okay, so what happened here? Look at this. What happened? We stop hunted that level that I identified. This level here I identified. We've stop hunted it. All right, price has moved up, hit our targets. Okay, so we only had 2 positions on this one. So we would have gone into drawdown by, I think it was 100 and, what we gone into drawdown by? 150. So we'd have got 150 into drawdown, entered into our second position. Okay, let's see how much money we'd have made on this. Let's just cancel this one off. Cancel this one off because we didn't use it. I'm going to set my stop loss on. Sorry, no, I don't set my stop loss on that one. So we've got these 2 entries. So we've got our buys and our buy limit there. Our TPs, we had one that made us £342 and another one that made us 488. So 4, 5, 6, 7, I don't know, 800 odd pound. So I went into drawdown by 150, made 800. Sound good? Now just remember, if you'd have taken a traditional trade, you'd have been stopped out on that, and lost £100 or whatever. You'd lost 150, wouldn't you, if you got in with a 0.3. Okay, so that's a working example of how you can enter your trades, calculate your lot sizing, and basically how you need to plan for drawdown. You need to be aware when you get in what the potential worst case scenario is. So by placing pending orders in the market like this, you can figure out roughly what you're going to get into drawdown wise. And if you go in with a 0.3 here, and you put the stop loss in place and it gets down to 550 at the next entry, that's way too big. So all you've got to do is come in and go, okay, well that's too big. Let me try a 0.1. Go in with a 0.1. Just get rid of that one and that one. So we're going with our 0.1. Put a little stop loss in there. Okay, and just move it down because we would have got in there. Figure out what happens at position 2 now. So position 2 now is going to be £50 in drawdown. All right, so I'm going to get into £50 worth of drawdown at my second position. I got £10,000 account. Am I comfortable with £50 drawdown on a position? Yeah. What's £50? I don't care. It's not a lot of money, is it? Not on a £10,000 account. But look at the reward I would have got because I didn't get stopped out. Okay, so that is how you can calculate your entries. And as I said, to start with, what I want you to do is just use 0.05 entries. So forget trying to do these calculations. I'm going to develop a tool that is going to be brilliant. It's just going to, what I've just shown you on the chart there, you're going to be able to press a button and it's going to do all that for you. Okay, hopefully it's out by now. If not, it's coming soon. All right, but for now, just get into the market with 0.05 every time you take a trade. And I'm assuming you've got here, okay, a £10,000, dollar, euro, whatever starting account. Okay, I want to talk about currency limitations and the 2-pair rule, because this is another very, very important part of planning your trade. When you plan to get into a trade, you're going to plan for your drawdown. Okay, we've just discovered how we're going to do that. But you also need to make sure and plan that you're not over leveraging on a particular currency. Okay, to be comfortable in drawdown, you need to limit the speed at which drawdown builds and happens. And one way we can do this is to ensure that you're not over leveraged in one individual currency. Okay, I've mentioned this a few times in other modules, but if you're long on the pound CAD and then you go and take another short trade on the CAD yen, for example, you are going to be short on CAD twice. All right. If the CAD suddenly gets strong, if there's a news event that comes out, say oil prices, for example, will affect the CAD. If CAD gets strong, you will go into drawdown on these two instruments at once, which will increase the speed you get to your maximum uncomfortable drawdown amount. Remember this percentage we've got, that we get 5% in drawdown or 10% in drawdown. I'm getting a bit uncomfortable now with this. You're going to get there a lot quicker if you're taking multiple trades on the same currency. Okay, so one way you can stop this, which you probably won't like the sound of, but if you can, try it and see how you get on. It was the one thing when I actually did this that I thought, this is awful because I'm only going to be in 4 trades a week or something, and it didn't feel like trading to me. I suddenly started making a load of money. If you can, try and only take one trade on a currency pair at once to start with. All right, so if you get into a pound CAD trade, you are now banned from all pound pairs and all CAD pairs. Okay, even if you see the setup of the century and you think, this is gonna tank so hard, I'm gonna make a fortune on it. If you're in pound CAD already and that's a pound yen trade that you see that's going to be a brilliant one, you don't get in it because you're already in the pound and you're already in the CAD. And if you think that other trade that you've just seen, that other setup, is the setup of the century, by all means, close your pound CAD out. At a profit, a loss, a break-in, wherever it is, if you can, get out of it. If you want to get into the other one, that's fine. All right? But try and do that. Try and just get into one currency at a time. When you're comfortable doing that, then only enter 2 trades on a single currency and always in the same direction, i.e. pound CAD and pound New Zealand. That's your lot on pound pairs. Okay, you're in the pound. Okay, I do this now. I have this rule now, and you'll see me in the Telegram group, and you'll see me in the live room. People will be calling out trades, going, "That's fantastic! Look at this EJ short," and I'll be like, "Yeah, it looks brilliant, great trade." I'm already short on the New Zealand yen and the pound yen, so I can't get short on the euro yen because I'm on two already. I'm on the yen twice. Okay, and I do that to this day religiously. Every now and again I break that rule. Okay, this week was one of those weeks where I broke that rule. We had some gaps in the market on Sunday. We had some New Zealand dollar gaps opening up. I jumped into 3 New Zealand dollar trades because I thought these are going to fill. These gaps have got to fill. They always do. Unfortunately, the New Zealand dollar pushed hard, and I went into drawdown on 3 of these New Zealand dollar pairs, and I got uncomfortable very, very quickly. And every time I do it, I get burnt. And every time I get burnt, it teaches me a lesson, and I won't do it again for a long time. But every now and again you make a mistake. I make mistakes. Everybody makes mistakes. We're human. But this cardinal rule of having 2 currency pair trades on at a time will save your life so many times as a trader, because it stops you over leveraging, and over leveraging is one of the key reasons we lose money. Okay, so that's the 2 pair rule and currency limitations. You'll be pleased to hear that's the end of this module. It's a short one at last. He's got a short module. The others have been hours long, but this one is a nice, quick, concise one, because it's just basically teaching you how to get into a trade. Okay, so here's your homework. You've earned a night off. Okay, I haven't got anything to do this time round. Just think about what you've learnt so far and have a look at any notes you've got. Just go over the course again, or the course notes again, and just cement what we've learnt so far, because tomorrow's module, or the next module you're going to do, module 6, is about drawdown control, and it's probably going to be quite a heavy one. Okay, this is what to do in emergencies. Okay, when we get to the point where it's hit our 4th entry and we have gone further and we're now well beyond our 4th entry, how do we get out of this situation that we've got ourselves into? Okay, so enjoy a night off. Don't do any homework. Have a little read over if you want to, but tomorrow's module, module 6, the next one is the last basic theory module before we get on to module 7, which is the entry criteria. This is the trades, and you may well have watched that already and come back to this one, but that's the one where I'm going to teach you exactly how I get in and out of the market, and hopefully then we'll be able to bring this all together and start making some money.